Let's talk about the tax basis of a property. When you initially purchase a property, the tax basis is equal to the cost, what you paid for the property, plus all of the expenses of acquiring the property. Those expenses could be legal fees that you paid to make sure the seller had clear title. They could be a buyer's commission. There could be recording fees. They could be investigative fees. There could even be travel fees to go see the property prior to buying it when you were looking at the property. So all those things become part of the purchase cost in the property, and that becomes part of the initial tax basis of the property. When you receive a property from a gift, mom says, I'm old, and she says, and I bought my house 40 years ago, and I paid $10,000 for it, but today it's worth $500,000. I own it free and clear, and I'm really worried about something happening to me, and you won't have the house. So I'm going to give you a deed. I'm going to quit claim the deed to you, and now you're going to own the house. Well, the good, the bad, and the ugly here is you get mom's basis. So if you sell the house at some later date, anything you make over her $10,000 that she paid for it is going to be taxable income to you. Gifts are not a great way of transferring property, especially appreciated real property. It's just not a great way because you get the giver's tax basis plus a teeny tiny adjustment if they had to file a gift tax return and pay some gift taxes. Not worth talking about. Much better, I inherit the property. There are ways to do that avoid probate, but let's assume that we have to pay the attorney some money for probate when mom dies, and I inherit the property, and mom's property she paid $10,000 for is worth $500,000 the day she dies. I would go get an appraisal based on the day she died. I need a real estate appraisal showing what this property was worth, and my tax basis would be what it was worth on the day she died. So if the appraiser said mom's house when she died is worth $500,000, the fact that she paid $10,000 for it, wouldn't care about that. I've got the house. If I turn around and sell it the next day and I get $500,000 for the house, I'm going to report I had $500,000 worth of proceeds. I paid $10,000 to the real estate broker as a commission. That means I get $490,000 net from the sale. My tax basis is $500,000. I have a $10,000 tax loss on the sale. Is that better than having a $490,000 gain on the sale? Well, it is to me, and it's certainly a lot better to not pay tax on $490,000, even if I have to pay the probate attorney. Now, you do need to make sure, mom needs to make sure her estate documents are up to date. We may be able to set up a revocable living trust that reduces or eliminates the probate expense. So there are some ways to do that. But the worst thing I see all the time is mom's in the hospital, mom signs over the house to her son who's worried about having to pay a lawyer. They do a quitclaim deed, and mom just says $10 and other good and valuable consideration. I transfer the house to my son, Jimmy. Then Jimmy goes to sell the house and finds out there's a huge, huge tax consequence that could have been avoided. Careful about these deathbed transfers. Be careful about how property is transferred to gift. This is the time before you set up one of these gifting transfers, when you're thinking about inheritance, to talk with your attorney and your tax accountant. Your attorney might be great at making sure title passes to you, certainly be good at doing a will, but we need to make sure we understand the tax consequences of how we're transferring the property. And the tax basis is an important consequence. You convert your personal residence. So I paid $100,000 for my house. It's now worth $200,000. I'm buying a new house and I'm going to rent the one I've got. My tax basis is the lesser of the fair market value, what it's worth when I convert it, or what I actually paid for it. So it's worth $200,000, but I only paid $100,000. My tax basis for depreciation, my tax basis as a rental is going to be the $100,000 I paid for it. If for some reason I paid $100,000, but it was only worth $50,000, the neighborhood went to heck, things are bad, real estate market's bad, the price went down, and I convert it to a rental, my basis for the rental is going to be $50,000. I paid $100 for it, but when it became a rental, it was only worth $50,000. That's my tax basis. Again, important to talk to your tax advisor when you're talking about doing these things. We want you to be able to get good advice and know what's going on. Depreciation, I talked a little bit about already. You have to take all the required depreciation. If you don't, you're going to have to recapture it anyway. Taxpayer, that you can only depreciate property that you own. You can only, property used in a trade or business, personal property cannot be depreciated, such as a rental, such as a business office, such as your warehouse. Those things get depreciated. Property that has a determined useful life, so land doesn't get depreciated. The building on the land does, but land lasts forever. Even if the sidewalks only last 15 years, the land itself lasts forever, does not have a useful life, so you can't depreciate land, and we have to, where the property has land, do an assignment of the value of the land as opposed to the building. Property is expected to last more than 1 year. It needs to be depreciated. So when I buy a dishwasher, other than the exception, the safe harbor that I talked about, election you can make, when I buy a dishwasher, it's supposed to last 5 years. I should be writing it off over the 5 years. I should be depreciating it. Those are important things to think about. And there is some Section 179 and some intangible rules, and that's a little more complex. You need to discuss those with your tax advisor. Examples, buildings and building components. My building, the roof for my building, all those things are depreciable assets. My dishwasher, the laundry machines that I put in my rental property, all depreciable assets. The carpets, the equipment, I got a hot water heater. I've got furniture. I rent the place furnished. I have appliances. Autos and transportation equipment would all be depreciable. Roads, shrubs, landscaping and fencing, but not the land itself. The land, air rights over your land, water rights, non-depreciable. Real estate depreciation rules, as we've said, non-residential property, 39 years, straight lines, divide the value of the building by the 39. Residential property, 27 and a half years. Where these numbers come from, this is what Congress determined were going to be the numbers when they did tax legislation. Land is never, but there may be some recovery things. Your sidewalks are 15 years. Certain buildings used for specific activities, things like places that sell gasoline, they have faster depreciation. Certain restaurants, certain leaseholds. So again, great things to talk about with your accountant. Here's kind of a list of depreciation. So if you're doing computers, it's 5-year property. Automobiles, 5-year property. Carpet, 5-year property. Office furniture, 7 years. Just an idea, a short page to get you the information. Passive losses. Real estate by definition is a passive activity. When you have income, that's great. Pay the tax. Government likes that. When you have losses, if it's a passive activity, the losses can only be used to offset income from other passive activities. Rental property A has a passive loss, loses $30,000. Rental property B makes $50,000 profit, taxable. Great, I can use the $30,000 loss to offset the $50,000 profit. I have taxable income from these two rental events of $20,000. Sounds great. However, if we flip it around and rental property A loses $50,000 and rental property B makes $30,000, I now have a $20,000 loss, which could be considered a suspended loss. And that depends. If my income is under $100,000, I can take $25,000 worth of losses and use them against any other income I have. Between $100,000 and $150,000, my passive losses that I can take, that $25,000 phases out. And when I have $150,000 in total income, all my passive losses have to be suspended, and they get carried forward until I have passive income. And I don't know about you, but keeping dollars today is always preferential to me than getting some dollars back at some day in the future, paying less on some day in the future. Your losses aren't gone forever. They're just out there sleeping if it's a passive loss until such time as you either generate income or you sell and completely dispose of the activity, the rental property. So important to know that. Important to know that if you're in this threshold, I had a client that had a $20,000 rental loss last year, and they took money out of their IRA and they pushed their income from $105,000, where they would have gotten the whole $20,000 loss, to $175,000 because they took $70,000 out of their IRA to do some home improvements. And I had to tell them that they were not going to get to use the rental loss. It was now suspended because they were outside of the income threshold. They had talked to me about the rental loss beforehand. I'd said, great, we'd run all the tax calculations. They did not mention they were going to take any money out of their IRA. And when asked about it later, they said, well, we weren't going to do that when we had the losses and we did our tax planning, but got to the end of the year and we decided that we needed the money and that we had a reason and we wanted to do it before the year was over. If they would have done it in the following year, I would have still gotten the losses and we would have generated a much smaller tax bill for them. So always important to let your tax advisor know what you're planning. And when your plans change, talk to them. There's nothing more heartbreaking than sitting with a client that you told how much money they were going to get back and how the losses were going to do them some good. And now I'm sitting there saying everything I told you about what you're going to get back and what's going to happen is not going to happen. You're going to owe more taxes. And, this all could have been avoided instead of taking this IRA distribution, which was not mandatory for them, on December 20th. If you would have waited and done this on January 3rd, I would have put another $8,000 and change in your pocket as a tax refund. Now you're having to pay money in. And it just, trust me, it's no fun for them and it's no fun for me. You can avoid these passive loss activities if you are in a real estate trade or business. So I am a real estate broker. I own the brokerage firm. I own more than 10% of the company. I spend my time working in the brokerage firm. I'm now in a real estate trader business. I'm a professional realtor. I spend all my time there. That might get rid of the passive activity rules. And now I can take my losses against my real estate income. I run a real estate appraisal firm. That could be considered a real estate trade or business, and it may get rid of these passive activity loss rules and allow you to take a deduction. If you are in a real estate trade or business, please, please, please discuss it with your tax advisor, especially if you have rental losses. Let's talk about the records you have to keep and what you need to do to take this $25,000 loss. If you qualify, if your income qualifies, you have to materially participate. And materially participate means that you have to be involved actively in the management of the property. So you need to keep a log of the amount of time that you spend. You need to be able to show that you didn't just farm out the management to somebody, that you substantially participate in decisions, approve tenants, check on rent being collected. You don't have to do your own landscaping, but you have to supervise the landscaper. So, and there are ways to do some of this if you have maintenance people, and not a problem. But if you basically are hands off and don't get involved, you're not going to even get the little bit of passive loss you might be entitled to. All right, so suspended losses are reported on 8582. Very important that you get this filled out and you carry it forward. I have people come into me that have sold property all the time, and they've changed accountants 2 or 3 times, and the accountant that they picked up, the tax person, didn't pick up the amount of suspended passive losses they have because it didn't make any difference on the tax return they were doing right then. And they sit down with me and I ask about losses. I ask to see all the old tax returns, and I find out that, well, the largest one I've seen, I had $298,000 in passive losses that when we went through all the tax returns and found what was unused and what was available for them to offset a gain, we got rid of all the gain, created a loss, got rid of the taxes, and this thing he had changed tax accountants several times, and the tax return showed carried forward losses of $48,000. They'd carried forward what happened since they took over doing the accounting for the property, the new accountant, but they never picked up from the prior accountants those loss carry forwards that were passive, that were suspended. And this would have cost the taxpayer a lot of money, other than somebody asked him to go see me. And when we went through and he said, how much are you going to charge? By the time I got done telling him the refund, he looked at me and said, it really doesn't matter because I'm going to end up with a lot of money that I was told I wouldn't end up with. So be very careful about this. We see it happen all the time because people don't give all the records the accountant needs to find those passive losses, and the accountant doesn't have a conversation with people to find out what's been going on and how long, and it just falls between the cracks. And the problem here is that it didn't affect the years they were doing. It's when they go to sell later that it becomes effective. I was very fortunate because this client had 11 years worth of tax returns, and there were 3 years of passive losses on the return since their new person had been doing it, but he had all of the tax returns completely for the 11 years, so I could go back and find out what got missed. That doesn't always happen. Sometimes clients don't have the records. Really important to keep the full copies of your tax returns. It's really important to make sure that there's continuity if you change tax preparers and your tax expert knows what's going on. We've talked a little bit about real estate professionals. If you're a real estate professional, the $25,000 limitation does not apply to you, but you've got to be eligible. You have to spend more than half the personal services performed by the taxpayer during the year are performed in a real estate trade or business. IRS defines these. I'm not going to spend a lot of time telling you what they are right now, but check with your tax professional. The taxpayer also has to perform more than 750 hours of service during that year in such real estate trades or business. I'm a real estate broker. I own the brokerage firm, but I only spend 50 hours a year. I'm not going to qualify. I haven't spent the 750 hours that are required. I also need to track the hours spent on my properties. So there is a way to group properties so that it's easier to accumulate the hours. I usually teach that in my real estate professional seminar, but just know that you can group properties together as an activity. There are pluses and minuses to this, and it's a long discussion you should have with your tax advisor. Rental activity is considered non-residential. So we talked a little about this, but short-term rentals where they're less than 30 days and they're significant personal services, that's really considered a hotel. Rental that's part of a hospital, an Airbnb could or could not be considered a rental depending on how that's treated and what services you provide. So it's just really important to understand non-residential and whether it's a trade or business. I've talked a little bit about that. And there are some court cases here which will be in the material. In the first case, the tax court determined that while the taxpayer did do 750 hours managing the property, that they were not a real estate professional and did not meet those requirements. So while they deducted $68,882 worth of losses, they were limited. Obviously, their income was under the $100,000. They were limited to the $25,000 that is allowed when you're under $100,000, and it was a passive activity. So the court cases are always interesting. We'll allow you to take a look, and as I say, they will be in the material when you get the link and download it. Want to spend a little time on qualified business income deduction. This was new last year. We did a lot of them without a lot of real understanding of what the rules were because they weren't finished. They've been cleared up a little bit this year. It is Section 199A of the Internal Revenue Service Code, part of the Tax Cut and Jobs Act. This is the first time, as I said earlier, that you get to take a tax benefit without actually spending money. Usually it's, spend $100,000, get a write-off for $100,000, save $30,000 in taxes. Well, that kind of means you're still out $70,000 in my figures. But in this case, you don't have to have spent anything. It is strictly an off-the-top equalizer to equalize small business with the lower corporate rates. And there's simply a formula, but you have to qualify. So that's really important. It's one of the things in the tax code that I'm just really surprised by pleasantly. So the deduction is worth up to 20% of the taxable income from a qualifying rental activity, a qualifying business activity, those that receive pass-through income from a partnership, an S corporation, all those things it qualifies for. It does not apply to C corporation. A deduction reduces your taxable income. It's simply a figure we put on your tax return to take this reduction in taxable income. It applies, as I said, across the board. It's taken at the individual taxpayer level on the 1040, not at the entity level if you've got an entity. It phases out for certain people in what they have qualified as specified trades or business. So if you're in one of these specified trades or business with income of more than $421,400 this year, you can't take this deduction. If your income is more than the $421,400 and you're not in a specified trade or business, you may be able to take it, but there are other parameters and limiters that come in, such as payroll and asset value. They can all come into play, and it becomes a much more complex calculation. It starts phasing out for single taxpayers at $210,000. And I'm sorry, the single taxpayers, it's gone. And for married taxpayers, it starts phasing out at 167 and is gone at 321. Just something to look at. Specified trades or business are things like professions, practice of law, accounting, things that are professions or what are considered personal service businesses for the most part. Most other businesses will qualify. And as I say, it can be figured for payroll and other things. Rental real estate, which by IRS definition is not a trade or business, is a passive activity, qualifies as a trade or business for 199A qualified business income deduction because that comes under section 162. And there are some rules you have to do. Type of property, whether it's rented, whether it's commercial, residential, number of properties, you can group these properties together, how much you're involved. You have to have some day-to-day activity in the property, acting as a business. It can't be just a triple net lease that the owner doesn't have to do anything about. Auxiliary services that may be provided. Hey, we clean the parking lot. We do, there are other things going on here. It's, as I say, not a triple net lease. The terms in the lease, all these things affect the qualifying trade or business. If you're not a triple net lease, it's probably pretty easy to get you to qualify. There is a safe harbor for qualifying. Again, you need to learn the safe harbor. The safe harbor is all about tracking not only you, but everybody that provides services on your property and meeting the service requirements for each property. You can group these properties. So I have a single family residence and I have a 15-unit apartment building. And I rent out the single family residence and I rent out the apartment building. But the single family residents, they cut their own grass. They pretty much do everything but, I have to collect the rent, pay the taxes at the end of the year. The single family residence is not going to meet the participation requirements. But if I group it and I group it with my 8-unit building, I can group all my residential rentals, my non-commercial and then all my commercial together. I can use the hours for the total of the two properties, and it applies to both, and I can get 199A. So there are sometimes a really good reason to group properties together. We do a whole class on grouping and to get 199A, and it might be something you want to talk to your tax professional about if you're not going to be able to meet the participation requirements on a property by property basis. You also have to keep separate books and records for each activity. So if the activity is the group, my two rental properties that are together, then I have to have a set of books and records for those. if I keep my property separate, I have to have my books and records separate. What books and records are? It could just be ledgers. The law doesn't define how complicated. I just have to keep them separate. So I can say this property generated this one generated this, and I have to have one consolidated one if I've grouped for the group, if I've grouped properties together. I also have to be involved here, and so do other people. They're looking at for this business thing. You have to have 250 hours or more of rental services performed on the property, but that includes, not you, can include the landscaper. My landscaper comes out and he spends 6 hours a week landscaping, or every 2 weeks he spends 6 hours. Okay, that's 12 hours a month. I can count those hours. Oh, I had to have a plumber out. The plumber spent 10 hours. I can count those hours. You got to get these 250 hours, but it's everybody that works on the property, and you need to keep track of it. You need to keep records that are at or near the time of event, some kind of logs, something that shows what's going on, what date were the services performed, who performed them, how long did they take. These records can save you real money, and it's important to do them. So you need to have all these records. You need to have the information that you need. You can put this together, and you can protect this deduction using the safe harbor requirements. To give you an idea, we put together this little spreadsheet we track it on. So I have 3 activities here. The activities are my triplex, my single family home, and my commercial property. And I track which property it's on. Is it on property 1, 2, or 3? I can sort this because it's in a spreadsheet. I had Dick's cut the grass. They spent 1.75 hours. They were on property 1. On property 2, we had to have some plumbing done. That was 2 hours. On property 1 again, there was some roofing and some painting. And I spent some time as the owner showing it and leasing it. We'll be able to figure this. If I thought I was going to run short, I could combine into one activity my triplex with my single family home, and then I'd have to hit those 250 hours for the 2 combined. Just really important to have these records. They are required for the safe harbor, and we want you to know about them. If you're an investor, some tricks that you can do as you go to sell property or to delay paying the tax. There's always the installment sale. You give me X dollars down and X dollars a month. I'm going to carry back the mortgage. I pay the taxes. I collect the money from you. I don't have to pay all of the tax up front. So an installment sale can work, but an installment sale is not really a good deal if you think the next guy in the White House is going to raise the capital gains rate or the taxes, and you're going to pay more as you collect the money. You really got to look at that and say, if you think that the current capital gains rate is as low as it's going to go, and you don't want to take a chance holding the money until such time later, then you don't really want an installment sale. If you would rather, hey, I'm going to spread that income over, it'll keep me in a lower tax bracket, I will be able to collect interest on some of that money that would have been taxed, I will be able to spread my tax liability, then an installment sale is a great way to delay. A 1031 exchange. I want to exchange my single family home for a triplex. I've got a big gain in it. I'm going to make $100,000 when I sell my single family rental. But instead of selling it, I do a like-kind exchange. That means that I trade the equity I have in my single family rental for the triplex. It's complicated. It has to be done through an exchanger, but I delay the tax until I sell the triplex, as opposed to having to pay the tax when I sell my single family residence. Oh, I sell it, I make $100,000. I got to pay $15,000 of that in taxes. Now I only have $85,000 of the profit left, so I got to take a bigger mortgage on my new property. A 1031 like-kind exchange is great. It can only be done with real property. We do have some new safe harbor rules for that, thankfully. And you do need to use a qualified intermediary. Your accountant cannot handle the transaction, and you can't touch the money. But it is a great way of rolling your equity into a new property. I've had clients do it where they've sold property up north, they've retired to Florida, use that exchange to acquire property in Florida, keeping their equity. And some of these people have substantial equity. We had one gentleman do it. He had a shopping center. There was $4.5 million worth of taxable gain that he would have had to pay tax on. And instead of doing that, he was able to buy 2 shopping centers in South Florida, put that equity, that $4.5 million, which he would have had to pay tax on, in its entirety without any tax, into the 2 new shopping centers using a 1031 exchange. So this can be a really powerful tool. It works with rental property. It doesn't work with personal property. I can't do it with my house, but business or investment property, I can do it with. And it delays, doesn't eliminate the tax, it delays that gain till such time as that new property is disposed of, assuming there's no exchange at that time. Grouping properties can also prevent you from having the net investment tax income. That comes from having too much investment income. If something is in a trade or business and qualifies for QBID, it also is excluded from being liable for net investment tax income. That's the extra 0.9% that goes towards funding the Affordable Care Act, and it's a way to reduce that tax. What Congress needs to know is, as they need to fix the passive loss. We've really hurt people with governors, other legislators, even the White House saying stay home. We have a suspended eviction process going on, so landlords are going to have more losses than they've had in many, many years. And if you were a business person, you'd get to carry it back. Landlords, in my opinion, are being treated unfairly. They provide housing for these people. They're the one that took the brunt of the, oh, I'm not working, I can't pay my rent. Well, okay, they won't be able to evict you. So the landlords really took it on the chin here, and Congress needs to at least let them carry back. But that's up to you. Contact your congressman, your legislator, your senator, and say, listen, I'm a landlord. Landlords need help. We're not those rich people that can afford to carry the whole world. We have mortgages to pay and other things, to expenses of running our properties. That would be really great if we got the NOL carryback. It would also be nice, I know they're talking about all sorts of subsidies now. They need to understand that giving a subsidy to a tenant who keeps the money, whether he buys groceries or just spends it, that subsidy that is intended so that because they don't have income, some of that should come to their landlord direct, just like the Section 8 housing program does not send the low-income housing people the money and say, this money is for your rent, go pay your landlord. Any provision that Congress makes to help catch up rents, pay back landlords for this, needs to be paid directly to landlords for the rents they lost, those subsidies. It should not go through the tenants' hands, or the landlords are never, ever going to see it. I wish I could make these changes. Unfortunately, not up to me. It's up to the taxpayers that want to write and let their legislators know. Certainly think it would be a good idea. If you have questions, you can always email me. Email steve@rmsaccounting.com. I will be happy to answer any questions that you have. If you'd like, there's a lot of information on our website, which is rmsaccounting.com, as well as we do regular posts on our RMS Accounting Facebook